And welcome back to Academic Market Insights. We've been on like a short sabbatical. Life's been getting in the way. I went far away to conferences. My laptop hated us, so we'll be playing catch up with a couple. Stop cracking me up over there. We'll play catch up with a couple of videos this week, most likely. We're going to start out with Dr. A responding to a question from a student, and I'm going to tell you something. Um, I'm old. I was actually called a dinosaur last week when somebody asked me a question at a conference. Yeah, no, it was a college student. I hope we cross paths again. But I was called kind of a dinosaur. But I'll tell you, the topic we're going to talk about today, surety bonds, I never really knew that much about them. So I know. And you got a question from a student about it, and you did a little research and go.
Yeah,
How's
so
that for
this,
an intro?
yeah. Well, and thank you very much, Dr. Rowe. Again, welcome to Academic Market Insights. If you like our channel, please hit subscribe and please hit like. Again, the likes are really big for my kids. They really enjoy seeing it. Um, but we do hope that you would want to come back and check out more videos, especially we are very open to suggestions. And last week we were covering fixed income, basic vanilla bonds, and a student asked, "What's a surety bond?" And I said, "I don't know. I've never heard of this." And Dr. Rowe and I were just speaking, these aren't traded bonds. So I felt a little bit better about that because it's not necessarily something that's going to be on our radar because this isn't the area of business that we happen to be in. This isn't something that you would see trade over in the OTC market. So these aren't necessarily tradable bonds. And we, of course, had to make lots of jokes that maybe they should be, and maybe there's a missed opportunity here. But before we get into that, let's talk about what they are and what they're used for. And really, I was fascinated by this, and I was also just really blown away with risk management. This is something that I really hadn't thought about. When we think about risk management, we think about the CDOs, the collateralized debt obligations, or even the swaps, and managing default risk and default events using those types of products. And this really is a completely separate beast. It looks at very specific events and will protect against those. So let's jump into it. Okay, I'm going to share my screen and we're going to do the slideshow from the start. Woo! And they're called surety bonds. So we're going to talk about what they are, how they work, and basically some of their uses. Okay, so they are a promise to cover or pay another party's debt or obligations if the borrower defaults. And this has had to be where the question really came from. Where, how is this different from a collateralized debt obligation or swap? And I want to make the comment that, yes, Dr. Rowe.
Darn it. I think this slide's going to answer my question, but I was really go back one slide real quick. Yeah, go yeah. That looks like a credit default swap.
Absolutely.
That's that looks like a credit default swap, and so there. And I
I
might
could
I might steal this and change where it says surety bond to credit default swaps for maybe one of my courses.
Well, yeah,
But
again, to Dr. Rowe's point, that's when we were first starting to go through this deck, I have to, before we even get into it, how is this different even from insurance? And insurance protects against accidents or unforeseen problems. And then the surety loan, or the surety bond, pardon me, protects against non-completion of a project. And we're going to look at other examples and variations and riffs of these, but it's not necessarily just a simple somebody didn't pay. It's not necessarily potentially a credit default obligation or CDO, but it really can also protect against, again, non-completion of a project. And the reason why I'm overemphasizing that particular one is for a lot of contracts, particularly if you're working with the government, these are required. So if you are working with the government, they will require you to get a surety loan so that if for some reason you can't complete the project, then there is a third party in place set up to be able to make sure that this project gets completed. And I was thinking about that. And again, this is really more for governments and government contracts. Wouldn't it be nice to have these for contractors? Right? Basic contractors that do work for your house, or even to have loans or these bonds that, for poor work, that if something needs to be redone. So let's
You
talk
get
about,
you get into a lot of opinion and flexibility around that one.
oh,
Like, and when you say like poor work, uh, we had some work done around the Rhodes household, and there are a few things that I've had to go behind and maybe tighten up just to, and you got to wonder how you would, what would justify the event that I get some sort of financial compensation for having to get out my own screwdriver and fix something.
absolutely.
Yeah.
And I know this is not a session on CDOs,
Mhm.
but even within a CDO, not only is there bankruptcy, but there are specific credit events that
Oh
are
yeah.
well defined and articulated, as
Yeah.
opposed to this idea that it only is bankruptcy. There are other things that
Mhm.
could happen. There are other triggers. There's covenants put into these products to protect the issuer and the payee. So, and so this is very similar. The surety bond is a third party agency that's going to protect the principal, and the obligee actually pays a surety bond, and then the surety bond, if the event occurs, pays out to, and most likely this would be to like the government. So this is a way to protect against some of those things. So when we think about this, we're thinking about a non-completion of a project versus insurance would be against specific accidents. This would be like, what is it, employee insurance? What is it? I remember working for a job and, just in case an accident, I was a waitress, just in case you slipped or something and you broke your arm, there would be insurance against things like that happening. But that's very different than not completing. That type of insurance won't protect you if for some reason you can't complete the job. Okay. So there is a procedure, and I was able to get quite a bit of this from the government. Um, they had broken out bond specifications into two different steps. And initially, the way it was described was one, determine the amount that you need and the protection that you need. And then you're supposed to gather information. To me, just based on working in fixed income, the idea of having all those specifications would be lumped together. So we're looking at not only the amount, we're not only looking at the specific event, we're going to be looking at the time frame, we're going to be looking at discount rates. All of that will be, to me, embedded into the bond specifications. Um, I did not get to see any of the pricing mechanisms for how these things are priced, but I would imagine that with these types of products, we're embedding in quite a bit of optionality. We're embedding in quite a bit of derivatives into these products because that's the nature of these products to begin with. Then you actually have to apply with the government, and then you're approved or not, you make your purchase, and then it's registered. So again, these aren't bonds that are being traded, they're more similar to insurance products in that regards. Dr. Rowe, what can I do for you?
Into this yet, but can you still do this? Or
I'm
did they
sorry.
fire? Can you still apply with the government, or did they fire everybody? I'm actually being serious because this, I mean, this is one of those things where if you work for the government and you say that this is what you do, you apply, you basically review these things and approve these things. I think it's a useful thing. I think it's probably something that we need out there, et cetera. But I can see in the current administration thinking this is something that might be done better by private industry.
Absolutely.
And I know I'm throwing a huge curveball at you there, and I apologize, but
No, I
when
think
I saw the government approved, and I'm just that's going to be stuck in the back of my head right now. And I know you've got the agency at the end of the presentation that does this. I'm going to go do a little exploring when we're done here. So
yeah, it's funny you should bring that up. And obviously, I would not have a good answer one way or the other because I have no idea how that would impact. I suspect, but I could be very wrong on this, that if we went to private, it might cost more because they might charge higher fees. But one could easily make the argument that the government is less efficient. So I don't know what the impact would be if this turned private. If it did turn private, I think there'd be a potentially higher likelihood that a secondary market for these things could and would start to exist. Because I could easily, as we're talking and as I'm speaking, I could see bundling these things up, selling them off. I just
people betting on other people not finishing their work.
absolutely.
And then you get a Tanya Harding, Nancy Kerrigan situation. If there was a surety bond on Nancy Kerrigan, she did make it to the Olympics. She persevered. But if there were a surety bond on her being able to compete after she got bonked on the knee, that bond might have paid off.
I might have.
So I know there have been some nefarious things in credit default swaps. You could probably see the same thing when there's money involved. Had a great professor who used to say, when there's money involved and you're close to that trough, it's really difficult to not reach in and take a little. Always
Uh,
like that.
Absolutely.
Mm.
And Nancy Kerrigan, if you are watching this, I'd like to do a small shout out to you. I loved you on Flea Market Flip. Keep on flipping, my friend. Keep on flipping.
I like the Campbell Soup commercial from 30 years ago. So
Oh, okay.
okay.
So we have different types, and I was boggled by this. Because again, these are not products because I don't happen to work in any of these industries that I would have thought about. So construction is what we've been really talking about. Auto dealers need this, credit repair needs this, private investigators need this. Public insurance adjusters and mortgage brokers. And I believe the question that is originated from my class was about mortgage brokers and and within that type of insurance. I also found these are the most common bonds in Illinois. So we're from the state of Illinois. I was pretty interested in this. Burvis Business Service Bond, Certificate Title Bond, Contract Title Bond, Freight Broker, Motor Vehicle Dealer, and Public Adjuster. We didn't have time to necessarily dive deep into any one of these, too many of these. I did take a quick look at the business service bond, which is what we're going to look at next. I was fascinated by this. And again, my brain, all I could think was, I would love to see how to model this. And these are two different types of surety bonds that we're looking at. The business service bond versus employee theft surety bond. The business surety bond protects against customers' financial loss due to employee misconduct. The employee theft protects against the firm's financial losses due to employee misconduct. So both have employee misconduct in them, but the entity that suffers is either the customer or the firm itself. And there are two separate, and I'm going to use the word insurance, even though it's not technically insurance, types of protection.
Insurance.
Pardon me?
But I mean, I think you can use the word insurance here. I
Yeah,
mean, we
it
could be
feels like
if
insurance.
we were talking about a put option,
Mhm.
I would continuously be saying that we're buying insurance on the future prospects of a stock, and that's kind of what you're doing here. But this is where I start to where something in my mind starts to get scratched a bit, and I'm like, okay. Uh, I used to cover retail stocks, and I went to a Home Depot presentation 30 years ago where the CEO claimed that $50 million worth of screws walks out, nails and screws walk out of Home Depot every year.
Wow.
Now, how much of that is somebody that works there putting them in their pocket versus a customer putting them in their pocket? Yeah,
Right.
that's I look at these things, and actually I just taught the bond section where you go through the bond covenant, which we would have covenants in these things as well, I'm sure. And just how do you what if back when I was a bank teller, my best friend Robert and I decided to fake a bank robbery? Well, I he's a, and that's the kind of stuff we might have done back in college.
What?
But
Because again, if you're too
but
close to the money,
but I just, yeah, no, I just, but I just, take a look at these types of things, and I'm like, the catalyst to pay off. And then anybody that's ever dealt with like a warranty or a home warranty or anything like that, that's, maybe you do want the federal government involved in these for that very reason. You want an arbiter that has no real financial interest in it,
right.
if it, comes down to getting paid off. But um, that's where I'm hung up on these things, but that's why we're doing these videos. And I wouldn't be surprised if we see a comment or two explaining this a little bit more.
Yeah, it's again, I was blown away by this entire world of financial products.
Mhm.
And again, to me, I love the sophistication of these very specific events for protecting against risk. So, when you think about risk, it's very easy to lump it in all as one thing. But once
Mhm.
you really start to be able to silo out these pieces of risk, it's easier to price the risk. It's easier to uh,
Mhm.
really pull it apart and take a look and say, okay, here's how we're protecting ourselves. These are the things that we're proactively doing. Uh, this I thought was just interesting. I did not dive too deep into mortgage loan origination,
Mhm.
but then this came from the Illinois government. What I thought was interesting, and the reason why I wanted to bring this up, is these surety bonds, in my opinion, feel very low in price compared to the amount that the original loan is. And from my understanding, the surety bond doesn't pay the entire principal back, but these seem very small relative. And I think this, again, getting back to your idea of it being privatized, this might change some of the product specifications because I think the private industry might have a better way to break up some of these bonds and some of these pricings. And then I think this is the last slide. Really, this comes from the Bureau of Fiscal Service, the U.S. Department of Treasury. And you do have to go through and actually register all of these bonds. And to your point, that you do have the federal government really working side by side with some of these firms. Get that's the last slide. And again, when we're thinking about these different types, we're thinking about motor vehicles, we're titles, we're thinking about employee theft, things like that. And as your point, that the US government is actually backing this. Okay.
So I'm digging. Where are the federal agencies where people have been let go?
Oh, I don't know if
I just
that,
found I found an article about it. So Financial Protection Bureau, they're gonna gut the 1,700 employee consumer watchdog agency.
ooh,
So you and I need to not publish this video and get to work on a private surety bond market.
we do.
Seriously, if I still worked at the exchange at the Chicago Board Options Exchange where I used to work, I would be looking into a public solution. I'd be running down to the guys in research and saying, this might be ripe for somebody to create a private entity to try to take you know to try to take this over. They on Valentine's Day they got a reprieve for firing everybody, but they're still kind of working on it. Um, so there. But yeah, that was when I apologize for that popping in my mind while we were in the middle of a video there. But
No, I think it's a great
yeah,
point.
I mean that's if these whole videos are nothing more than the kind of discussions that we have all the time, just with a camera in our face. So there. So you want to take us home on surety bonds? I'm like I've got 3 risk management books I've taught out of, and I don't even know if there's anything. That's what I was looking over for. I don't even know if there's anything about surety bonds in there.
I don't think I've
And I
seen
mean,
it.
this is, and you know what? The reason there's not is there's no way for people to be making money off of it.
Right. That's what it's not.
Goldman Sachs will come to you and create a package solution to do some of this stuff. And they'll probably charge you a bit more for it as well. And God help you if you try to get paid off. And not just them, any of the big investment banks out there, because I'm afraid of them. All right, go ahead, take us home.
That's just well, we hope you enjoyed today's videos. Thank you so much for joining us. We thoroughly enjoyed digging into something that we really didn't know anything about. It was fascinating to find, again, the just level of sophistication out there and the curiosity of where these things came from and how they're used. If you like this, please hit like, and we also ask that you subscribe. If you have any comments, constructive criticism, or any suggestions, we welcome all feedback. Thank you so much.